There are now over 100 weekly dividend ETFs. Which one is the best? In this video, we're going to go over my top 5 weekly dividend paying ETFs and ones that you should consider watching. Now, even though we have 108 weekly paying dividend ETFs, more and more are on their way. A lot of ETF providers are changing their payout frequency to make it weekly because that's just what investors want, and they want part of the market share. And because a lot of these weekly paying ETFs utilize options or swaps or leverage, they are able to generate income than traditional companies as it would with dividends. So a lot of these ETFs on this list are actually distributions, not dividends. And for tax purposes, they are taxed a little bit different because majority of the time, a portion of those distributions are going to be taxed as return of capital. So it's going to be tax deferred until your cost basis hits 0, and then you'll start paying taxes on those distributions. So taxes on these ETFs can be quite complicated, but it is something you have to keep in mind because you want to set aside some cash that you're making from these ETFs for taxes in the next year. But let's hop into our first ETF on our list, and that is, of course, going to be WPAY, the Weekly Pay Universe ETF. It's basically a fund of funds from Roundhill ETFs. And this is one of my favorite weekly paying ETFs as of right now. It has a very respectable distribution rate of about 73%, and it is diversified because it is containing all of their single stock weekly pay ETFs into this one ETF. And the best thing is the management fee is actually waived to 0% until at least September 30 of 2026. So you're going to have a lower management fee for a whole year, which is great to see. So why invest in WPAY? Well, of course, you're getting distributions every single week, and it's going to be a recurring income stream for shareholders. Now, of course, all the ETFs on this list are going to be distributing payouts every single week, but WPAY is one of the best out there right now. And of course, you're getting diversification because you're getting exposure and equal weighted exposure to the entire suite of the Roundhill Weekly Pay ETF lineup. And every single month, they are going to rebalance the portfolio to make sure it is equal weight and ensuring consistency exposure to all of the single stock weekly pay ETFs inside the single stock ticker. And if we take a look at their lineup, we can see we have about 15 or so single stock tickers. They're coming out with more and more. We actually have 18 or 19 rather of these weekly pay ETFs, and it's very nice to see that they're coming out with more and more single stock ticker ETFs, which are in turn going to make WPAY more diversified because it's going to contain all of their single stock ticker ETFs inside this one ETF. And if we take a look at the fund details, you are going to have a net expense ratio of 99.99%. And once that waiver expires, or if they renew it, the expense ratio will go back to 1.28%, which is on par with other ETFs such as ULTY, just because there is some management. Even though it does say it's a management style of passive, it does have to rebalance every single month. So I do think they could maintain that 1% expense ratio, but we'll have to see next year. And one of the best things about this ETF, compared to some of the other ETFs that are paying out weekly, is the share price appreciation. It's going to be 1.2 times leverage. Let's actually open up one of these single stock tickers. We can see it's going to have amplified returns by targeting 120% or 1.2x of the underlying's weekly performance. That is something to keep in mind. It is using a little bit of leverage in order to amplify and juice up those performance distributions and that NAV. But we can see it's been doing pretty well. In the past month or so, it is down 4 or 5%. But since inception, it is up almost 3%, which is very nice to see. Now, I do want to keep in mind that this is a volatile ETF because of that leverage exposure. So you are going to go down a little bit with the market. And if we take a look at the total returns, you're going to be up 10% if you bought in at inception and reinvested all your distributions. So a 2-month time window for 10% return is absolutely amazing, and that is factoring in that drop we had last week. Now our second ETF on our list is going to be ULTY, the Yield Max Ultra Option Income Strategy ETF, and people have had a love-hate relationship with this ETF. It was performing quite well earlier in the year, but now it is sitting at $5 per share, and people are just not happy with it. But the strategy for ULTY is a bit different. It doesn't use leverage, but instead is going to invest across 15 to 30 underlying stocks selected based on high implied volatility levels, because the more volatility there is with an underlying, the more option income you can generate and distribute. Now, the third point for this fund does say it has upside participation, but we know that it's capped because they're using covered calls, and if the underlyings skyrocket, which we've seen some of the underlyings do, ULTY is not going to increase in price as much as the underlyings, which was a disappointment for a lot of people. But the good thing is it's been paying out consistent distributions. We can see it's been paying out 9 cents for almost 4 months now. And then we had some 10-cent payouts earlier in the year. So this fund has been paying out 9 to 10 cents on average per share for almost a full half a year, which is absolutely amazing to see, very consistent. And it is one of the reasons why I am still invested in ULTY for those consistent payouts. And if we take a look at this share price, we can see it's down 75% all time, which is absolutely absurd. That is the main reason a lot of people don't like this ETF, and especially since it does have a higher than normal expense ratio of 1.30%. However, we do know they underwent a strategy change late 2024, which made this ETF popular again. And that was around December-November timeframe. So this ETF has dropped 50% since that strategy change, and that is something to keep in mind. Now, here's the interesting thing. If we take a look at the total return, you are up 12.30% year to date. Now, since inception, you're going to be up 12.90%. So you actually have a positive total return if you're factoring in all those distributions you're receiving. Because remember, ULTY pays about 80 to 70% annualized every single week. And if you're reinvesting all those distributions, you are going to get more shares of this ETF and in turn, more income generated week over week. Now, if we cherry pick a little bit and look at the past month, it's down 12%, which is not great. So let's actually plug this in, see what type of total returns we're getting from September 24 all the way until now. So we've plugged in our start date, September 24th, and we can see our total return is going to be negative 5.21%, which is not nearly as bad as a 12% drop, but it is still a negative return in the past month. That is primarily the reason a lot of investors have favored WPAY over ULTY, because there's more upside participation with that ETF. Now, our third weekly paying ETF on our list is going to be BLOX, the Nicholas Crypto Income ETF. And this fund has done quite well since inception, but it is still very new. It is an actively managed ETF providing exposure to blockchain technology to enhance income and provide portfolio diversification. So we can see the fund objective is quite simple. You're going to have exposure to Bitcoin and Ether, as well as crypto industry companies, which is going to give you weekly income. They're going to sell options on these crypto industry companies in order to generate that weekly payouts. And then we want to note the expense ratio, which is 1.03%, which is pretty much on par with the other ETFs on this list. And here is the main reason this ETF has been popular lately, is because you're up 27% since inception, which was June 2025. So an insane share price return for a lot of people who have gotten into this ETF early, as well as these people are also making a lot of dividends every single week. We can take a look at the holdings. You're going to get exposure to Bitcoin through the VanEck Bitcoin ETF, as well as the Fidelity Wise Origin Bitcoin Fund, which are going to take up about 20% of the portfolio. And then you also have ETHA, the Shares Ethereum Trust, taking up about 7% weighting. And then the rest of these companies are going to be those crypto related companies. And then in this ETF, they're going to sell options against those companies to generate the income. So let's jump into the juicy stuff. BLOX is up 43% since, which is June 2025. That is an insane total return with distributions reinvested. In just 4 months, you're up 44%. That is higher than most of these other ETFs on this list, and it has been one of the more popular ETFs because of its capped upside potential and consistent weekly distributions. Now let's take a look at what it has been paying out. It's been paying out a little bit volatile. It's been 13 cents, 15 cents. So between 13 cents per share to 18 cents per share, you can expect a net dividend amount per week between that range. But so far, BLOX has been one of the best weekly paying ETFs in terms of total return. Now, of course, we're not too sure what's going to happen in a prolonged bear market, as a lot of these ETFs are quite risky and are prone to a lot of downside risk. But for now, in a bull market, it's been performing quite well. Now, our fourth weekly paying ETF on our list is going to be XDTE, which is the S&P 500 0 days to expiry covered call strategy ETF by Roundhill ETFs. And it's going to utilize a synthetic covered call strategy seeking to provide current income on a weekly basis. So just like other covered call strategies, you are going to have capped upside, but the best thing about this ETF is it's not going to have options that are rolling over to the next day. They're opening and closing these covered calls the same day. So it's a very unique strategy, and it requires a lot of active management. So it does have an expense ratio of 0.97%. Now, I've been holding this ETF for quite some time now, so I've seen the performance through bull markets as well as some drops, and it has been quite shaky during those drops because you have unlimited downside risk if the S&P 500 drops significantly. So we take a look at the all-time chart, and keep in mind this ETF has been out for quite some time now, since March of 2024, and it has been quite consistent all the way up to 2025, and then we saw that huge drop in April, and XDTE dropped with it from about $53 per share all the way down to $40 per share. And then we had that insane bull rally this year. And while XDTE did have some share price appreciation, it did not recover fully from its April crash, which is quite sad to see, but it has been consistent since. And if we factor in all those weekly distributions, keep in mind it has a yield of about 30%, then you are looking quite good. Because if we look at the total returns, year to date, you're up 9%, and the overall return since inception of March 2024, you're going to be up 26%. So this fund does perform well. It is consistent, but you are sacrificing that upside potential if the market happens to rally due to that 0 days to expiry covered call strategy. And our fifth ETF on our list is going to be one by YieldMax, which is going to be YMAG, the Magnificent 7 Fund of Option Income ETF. Now this is going to give you concentrated tech exposure. Tech is super bullish lately, and it's going to focus on the Magnificent 7 companies, which is going to include Apple, Microsoft, Google, Amazon, Meta, Tesla, and Nvidia. And it has a distribution rate of about 73%. So this is kind of like a fund of fund by YieldMax, but it's going to be concentrated on to the Magnificent 7. And we can see since all time, it's down 24% all time since February of 2024. But if we're factoring in all those distributions, you're going to look pretty good. So if we head over to the total real returns, we can see year to date, you're up 13%. And your total return is going to be 54% since January of 2024, which is a very respectable total return considering we had this huge drop in April. And then just like XDTE, it hasn't fully recovered because it is using a covered call strategy, which is limiting its upside potential. And that is a trade-off with covered call ETFs, and it's one of the main reasons why people are investing in other ETFs that don't cap the upside, such as BLOX or even WPAY. They don't want something that continues to go down in value, and we do want to rally with these bull markets in addition to receiving weekly income. So let me know down in the comments what your top weekly paying ETFs are. The ones on this list I'm a huge fan of because they are diversified. I'm not a huge fan of those single stock ticker ETFs. I think those have a lot of risk, but some of them have been performing quite well, such as PLTY. But those honestly are not for me. Let me know down in the comments what your favorites are.